Well, the negative performance is continuing this morning. Take a look at the futures indicating another sell-off at the open this morning. Concerns over the Federal Reserve potentially raising interest rates, as well as uncertainty around the election. Hillary Clinton's medical emergency yesterday adding a new layer of uncertainty to the market. Joining us right now is Federated Investors Chief Investment Strategist Phil Orlando. And Phil, even before Friday's sell-off, you were expecting selling in this market. Why?
We've been expecting a 5 to 10% correction. Stocks, in our view, are priced to perfection up here at around 19 times earnings. The earnings haven't been great. The economic news hasn't been great. You've got the growing uncertainty about the Federal Reserve and fiscal policy coming out of the election. For all those reasons, we felt that a pullback was warranted.
So in other words, 5 to 10, then that means you're still expecting the selling to continue. We're sort of in the middle of it then.
Yeah, 2100 market is sort of right where we are here. We could pull that back to 2000 or so. Let's get that 10% back and see where we stand.
Yeah, we're at 2101, Kevin.
I think a lot of investors are trying to figure out, though, when something like this happens, is this a buying opportunity, right? So they say, okay, do I wait or do I get in and purchase because there's so much cash out there? But they're trying to figure out, is there something on the horizon that we don't know that could make it stay low so it's not a buying opportunity, right? So one of the biggest things that concerns me is the second half earnings environment, right? They haven't come down. You've seen companies give poor guidance for the second half of the year. Do you see that being an impediment for future returns?
I think it's a huge issue, and specifically looking at 2017, consensus earnings for next year around $135. We're at $125, and the reason for that is we're concerned about the direction of energy prices and the dollar, which are two critical variables impacting corporate earnings. If we're right in terms of being a little too cautious or being a little more cautious, the street is valuing securities too high, and that's got to work its way back. And I think we're going to start to see some of that reevaluation now.
So yeah, go ahead, Sean.
We saw the market move a lot after a Fed official spoke Friday. There's another speech set for today in Chicago. What kind of clues are you looking for in that speech, and how much could it change the market?
So Brainerd is speaking at 1 o'clock in Chicago this afternoon. There have been a number of Fed speakers over the last 2 weeks, starting at Jackson Hole through Eric Rosengren on Friday, and they've been telling us that despite the fact that the data right now, inflation and labor market data, in our view, doesn't really support a Fed hike, the Fed seems as if they want to try to force a hike here in September. Brainerd is someone who's very smart and very influential. She has Janet Yellen's ear, and she's been very dovish up until now. So the question is, on what side of that argument does she come down at 1 o'clock this afternoon?
Well, one of the biggest arguments, I think, for the Fed is that they are trying to do a wealth effect, right? And that's all their policies since 2009 to now has led to that. That's why you've seen the recovery in the equity markets. It's mostly been to multiple expansion, not earnings expansion. So I think the Fed will not raise because they're going to look at the market. They're going to say, we've got a VIX above 20. It's really volatile right now, and we're seeing earnings aren't that great, and we're seeing the market pull back. And I think they're letting the market tell them not to raise rates. Do you think that's one of the biggest data points they look at?
I think you're spot on. I mean, our view is that September 21st rate hike would be a mistake. We think that the December period would be a much better period. We went back over the summer and looked at the history of Fed rate changes in presidential election years. And what we found is over the last 30-some-odd years, only once has the Fed hiked interest rates between the Labor Day to Election Day period. And the reason for that is that they don't want to be in there potentially impacting the economy or the markets or the election itself. So from our perspective, the smartest course of action would be to do nothing in 2 weeks. But that's not what the Fed is telling us.
Then there's this, in the cover story of the money section of the Journal, big Italian banks, woes reverberate. I mean, the story in Europe is still negative. These Italian banks continue to see real losses.
Well, the last time the Fed hiked interest rates, Maria, was mid-December last year. The market perceived that to be a policy error because the next 2 quarters, we now know, first quarter and second quarter GDP were very poor, down around 1%. The market's response to that rate hike was down about 12%. So the concern is, if the Fed tries to force a rate hike here, and the market, again, perceives that to be a policy error, do we trade off another 5–10% or so? That's absolutely possible. I think that's what the market's concerned about.
I think that has to go into guidance, right? So the Fed, when the Fed did raise rates last December, they actually gave guidance of 4 rate hikes this year alone, which really spooked the market. So I think if the Fed does raise rates, they need to have better guidance saying, we said we're going to be slow and steady. Maybe it'll mean 1 hike, maybe it'll mean 2, but they need to give that guidance because I think that's what really spooked the market.
Well, agreed. And when Stan Fisher came out and told the street, you know, we're on course for 4 rate hikes this year, folks like us were looking and saying, what data are you looking at? There's zero chance the Fed can justify 4 hikes given what we thought was going to happen in the economy. And it appears that the street was righter than the Fed so far based upon what's transpired so far this year.
What about the election and this Hillary Clinton news yesterday? I mean, we all watched that video of her stumbling. She was trying to get into her van, left the 9/11 ceremony earlier than expected. Does that play into the uncertainty as well? Because
potentially.
Yeah.
All right. I had pneumonia personally a couple of years ago,
yeah.
and I felt like I was hit by a Mack truck.
Really?
So the doctors gave me some Z-Pak. I felt really good after about 5 days, but they shut my travel down for about a month. Because they were concerned about relapsing. Well, she's in the middle of an election here. She's just canceled a California trip. If her doctors shut her down for some period of time, not traveling, not flying because of the risk of a relapse, does that impact the election? And that's a tough question.
And you think investors are looking at that and putting that into their whole idea of, you know, do I put money into the market now? Do you think that's actually a factor?
I think this is a brand new piece of information because what happened yesterday, the markets were not open, and so we've got to evaluate. You know, we've got this big debate coming up on September 26th.
Sure.
I think that's going to be huge.
Totally.
And I think investors are starting to realize that this thing looks a lot closer than it did a month or so ago, and maybe we've got to pay attention and consider the possibility that Mrs. Clinton is not a shoo-in, and we've got to consider the alternative.
All right, so you're telling clients to stay on the sidelines right now, then? You're expecting more selling for stocks.
So we're sitting here, our allocation on the global allocation fund is just slightly above neutral, about 62%. Now, years ago, we were up around 80 or 85% stock. So we've pulled that back, and we're saying, okay, there's a lot of uncertainty out there. Let's try to get some visibility here and wait for better valuation levels to put some more money to work.
All right, Phil, good to see you.
Thanks for having me.
Thanks so much. Phil Orlando from Federated Investors. Still to come.